Let's talk about what just happened. Let's be completely honest about it. Silver July futures opened at 74, but a lot 18 this morning. By 9:36 a.m. ET, it had slid to 71.21. That is a metal that was trading at 121.64 on January 29th, now sitting 41% below its all-time high, down more than 5% in just the past month, down further this morning after the May jobs report smashed expectations, 172,000 payrolls added, unemployment unchanged, and Hezbollah rejected an Israel-Lebanon ceasefire, sending both oil and uncertainty right back up where they came from. If you hold silver today, that number on your screen is uncomfortable. If you are sitting on the sidelines watching this, you are probably asking the question this video is named after. Is this a buying opportunity, or is this the beginning of something much worse? I am going to answer that question directly. Not with optimism, not with doom, with the historical record, the current data, and the one distinction that separates every silver crash that was a buying opportunity from the ones that were not. Because they are not all the same, and treating them as if they are will cost you money in either direction. Let's start with the record. 4 times in the last 50 years, silver has experienced a crash of 30% or more. 4 times investors have stood exactly where you are standing now, staring at a number that used to be much higher and asking whether this is over or whether this is the moment. The answers were different each time. Understanding why requires looking at what was happening underneath the price, not at the price itself. The first crash was 19. Silver had just run 125% in a matter of months on the back of Nixon, closing the gold window, surging inflation, and the first oil crisis. Then it collapsed 45%, not 20%, not 30%, from peak to trough over roughly 2 years. Investors who had bought near the top watched half their position evaporate. Many of them sold. The ones who sold locked in losses and never came back to the silver market. The ones who held or bought more into the decline watched silver go on to produce one of the most explosive moves in commodity history. From the 1974 correction low to the 1980 peak, silver climbed from roughly $4 to $50, a 1,150% gain. The 45% crash was not the end of the bull market. It was the intermission between its first act and its most profitable act. What was underneath the price during that correction? A structural monetary environment of dollar debasement, persistent inflation, and an energy crisis that Congress was incapable of resolving quickly. Sound familiar? The second crash was 1980 itself. Silver hit $50 in January of that year, and then the COMEX changed the rules. Silver Rule 7 limited the number of contracts any investor could hold and raised margin requirements dramatically. The Hunt brothers, who had accumulated over 100 million ounces, could not meet the new requirements. Forced liquidations flooded the market. Silver fell from $50 to below $10 within months. This one was not a buying opportunity at $40 or $30. This one was a genuine structural break caused by a regulatory intervention that changed the rules of the market mid-game. The crash had an identifiable non-fundamental cause. The market had been cornered by 2 individuals. The regulator stopped the corner, and the price reverted to a level that reflected actual supply and demand rather than a squeeze. Anyone who bought that crash expecting it to resolve like 19 waited a very long time. The lesson from 1980 is specific and important. Not every crash is a buying opportunity. Crashes caused by manipulation terminating are different from crashes caused by temporary macro headwinds. The distinction matters. The third crash was silver was trading near $19 in February, and by October it was at $8, a collapse of more than 50% in 8 months driven by the global financial crisis, liquidity panic. When markets seize and margin calls cascade, everything gets sold regardless of fundamentals. Silver, despite being a hard asset, was sold to meet margin requirements on everything else. The buyers who stepped in at $9 in late 2008 watched silver reach 49.51 by April 2000. Was the most rewarding crash entry point of the modern era. Not because silver was fundamentally cheap at $9, but because the crash had created a disconnection between silver's paper price and its physical reality that the market eventually corrected violently upward. What ended that crash? The Federal Reserve's quantitative easing programs injecting liquidity, weakening the dollar, and validating every hard asset thesis simultaneously. The buying opportunity in 2008 was real, and it was visible in hindsight to everyone who was too scared in real time to act on it. The fourth crash was 2011. Silver peaked near 49.82 in April and fell more than 30% in just over a month. The CME raised margin requirements 5 times in 8 days, triggering forced liquidations that mirrored the 1980 playbook. Silver eventually bottomed near $14 over the following years. This one was not a decade-long buying opportunity at $35 or $30. Because the structural conditions that had driven silver's 2008 to 2011 surge were unwinding. The Fed's quantitative easing programs were ending. Real yields were beginning to normalize. The industrial demand supercycle that we have today did not exist in 20. Solar panels were consuming 75 million Oz of silver annually in 20. Today they consume 232 million Oz and rising. The structural demand story of 2011 was thinner than the one that exists right now. When the monetary tailwind stopped, silver had nothing underneath it to prevent a multi-year decline. That history gives you the framework for the only question that matters about today's crash. Which category does it belong to? Let me be precise about what happened on January 30th, 2026, because that is where the current crash began, and understanding that origin determines everything else. Silver hit 121.64. The same tool used in 1980, the same tool used in 20. The mechanism is identical. Leverage positions got margin calls. Forced liquidations created selling that had nothing to do with whether silver's fundamentals had changed. The metal fell roughly 30% in a single day, the worst single-day decline since, and then continued sliding as the Iran war broke out on February 20. The Strait of Hormuz was closed, oil went above $100, inflation expectations exploded, and the Federal Reserve's rate cut timeline evaporated. Silver has gone from 121.64 to 71 on $1.21 this morning, a decline of approximately 41% from the all-time high. Now, which category? The category is determined by what is underneath the price, not by how large the decline is, not by how fast it happened, by whether the structural conditions that drove the bull market are still intact or whether they have been dismantled. Here is what is underneath the price of silver right now. The Silver Institute's World Silver Survey 2026, published April 15th, confirmed the sixth consecutive annual supply deficit projected at 46.3 million Oz. The cumulative deficit from 2021 through 2025 alone is approximately 900 million Oz. That number did not shrink because the CME raised margins in January. It did not shrink because the Iran war pushed oil above 900 million Oz of structural shortfall built over 5 years sits underneath this price. Every week the war continues and the paper price gets suppressed. Physical buyers accumulate at lower prices and the shortfall deepens. Mine output is flat at approximately 820 million Oz per year. It cannot be increased in response to price signals because 72% of global silver production comes as a byproduct of copper and zinc mining. Silver miners are passengers in their own mine's production schedule. Building a new primary silver mine takes 5 to 7 years. The supply response to 3 years of elevated silver prices arrives in 2030 at the earliest. The structural deficit is not a 2026 story, it is a decade-long story. Industrial demand is not softening in any way that changes the decade-long picture. Solar manufacturers consumed 232 million Oz in 2024. They are thrifting silver per panel, but installing more panels. Electric vehicles consume somewhere between 550 and 1,150 metric tons of silver in 2026, from roughly 22 to 23 million units sold globally. AI data centers are creating a demand category for silver that did not exist 5 years ago and that most demand models have not yet fully quantified. Goldman Sachs calls silver the primary strategic metal of the green transition. That designation does not change because Hezbollah rejected a ceasefire this morning. China's export licensing restrictions in force since January 1st wall off 60% of our global refined silver from the international market per Peel Hunt. China made that decision because its own domestic industrial sector needs that silver more than the international market does. That decision is not reversed by a jobs report. The COMEX physical coverage ratio sits at 13. Paper leverage is at 7.5 times the available deliverable supply. The March 2026 delivery cycle pushed delivery demand above 60% of registered inventory and forced the CME to raise margins for the second time in 2 months. A market operating at 13.4% physical coverage is a market in structural stress that is being temporarily papered over by a monetary headwind that has suppressed the investment premium, and that monetary headwind, the real one, is the Strait of Hormuz, not the Fed's rate policy in the abstract, the Strait. Because JP Morgan said it explicitly in their April research note, interest rates have become very sensitive to energy prices and should come down meaningfully once flows through the Strait of Hormuz normalize. The war closed the Strait. The Strait pushed oil above 100. Oil above 100 gave the U.S. its hottest CPI in years. Hot CPI removed the Fed's ability to cut. Inability to cut kept real yields elevated. Elevated real yields suppressed silver's monetary premium. That is the chain. Every link of it traces back to February 28th and one oil choke point. Is that choke point structural? Is the Strait of Hormuz permanently closed in a way that changes the decade-long demand story for silver? No, it is not. The 60-day MOU agreed by U.S. and Iranian negotiators remains on Trump's desk. The Israel-Lebanon ceasefire that Hezbollah rejected this morning is a separate track from the U.S.-Iran negotiation. The PBOC added gold for the 18th consecutive month in April. The Republican-controlled House of Representatives passed resolution this week to block Trump from continuing military action against Iran without congressional approval. The diplomatic pressure for resolution is building from multiple directions simultaneously. The war ends, every war ends, and when this one ends, the entire chain reverses. Oil drops, CPI falls, Fed cuts, real yields compress, dollar weakens, silver's monetary premium returns on top of the structural demand floor that never went anywhere. Now, let me say something that the purely bullish silver channels will not say to you clearly. There is a scenario in which today is not a buying opportunity. It exists and you need to know it. If the Iran conflict does not resolve and oil stays above $100 through 2027, if the Fed hikes rates in December, which CME FedWatch currently assigns above 55% probability by year-end, if the 10-year Treasury yield pushes toward 5% and real yields widen significantly further, if the growth side of the economy deteriorates faster than the inflation side because of sustained energy costs, creating a recession rather than a soft landing, in that scenario, silver visits the $60 to $65 range before it finds its next structural floor. The $70 support that has held since March gets broken. The paper market's ability to press prices lower and elevated real yield conditions continues working against the physical floor. That scenario is not the base case for any major institutional forecast. Goldman Sachs projects $85 to $100 silver for 2026. Citigroup has $110 for the second half. Bank of America's Michael Widmer has a range of $135 to $309. Commerce Bank has $90 year-end. None of them are modeling a permanent war. None of them built their targets on the assumption that the street stays closed through December, but the probability is above zero. You should hold it with honesty. What distinguishes today's situation from 2011, the one crash in the last 50 years that was not a multi-year buying opportunity, is the demand structure. In 2011, when the monetary tailwind ended, there was nothing underneath silver except jewelry and industrial applications that were priced into $15 to $20 silver, not $50 silver. Today, when the monetary tailwind returns, it is returning to a market with 6 consecutive years of structural deficit, 900 million ounces of cumulative shortfall, a solar industry consuming 40% of annual mine output, an EV sector that barely existed in 2011, an AI infrastructure category that did not exist at all, Chinese export restrictions that did not exist, and COMEX physical coverage at 13. That is the difference between 2026 and 2000. The gold-silver crash history analysis published March 2026 made the definitive statement on this clearly, and I want you to hear it directly. The biggest single-day crashes in silver's history almost always happen inside bull markets, not at the end of them. Volatility is the price of admission. The investors who get shaken out during the drops are the ones who miss what comes next. Silver tripled from its 19. It gained 460% from its 2008 crash low by 2. Silver's current crash is 41% from the all-time high, which is well within the historical range of corrections that preceded silver's most explosive subsequent moves. The correction itself tells you nothing. The structural conditions underneath it tell you everything. At 712.1, silver is 102% above where it was 1 year ago per Trading Economics. It is more than tripled from its 2023 lows. It has a Reuters analyst consensus forecast of 79.50 for the full year of 2026 that it is sitting below right now in June with 6 months left. Every institutional analyst who built a bullish silver model for 2026 built it around structural forces that are still intact. Not one of them built it around the Strait of Hormuz being permanently closed. The question this video asked was whether this is the buying opportunity of the decade. The honest answer is that it depends on one thing you cannot fully know in advance: whether the monetary headwind, the war, the oil price, the Fed's resulting inability to cut resolves in 2026 or extends into 2027 or beyond. If it resolves in 2026, the structural floor plus the returning monetary premium adds up to a move that makes 71 total dollars look like the 2008 equivalent of 8. If it extends, the floor holds but the ceiling stays capped and you are waiting longer than you expected. What is not in question is the floor itself. 6 years of structural deficit do not disappear because silver fell 41% from its high. 900 million ounces of cumulative shortfall do not disappear. China's export restrictions do not disappear. The solar, EV, and AI demand story does not disappear. The COMEX physical stress does not disappear. The floor is real. The return of the monetary premium is a question of when, not if. And the investors who are sitting in $71 silver right now, holding through the war's resolution the way that 1974 investors held through a 45% correction, are the ones who will look back at this moment the way those investors look back at 1974, not with regret that they sold, with clarity about what they were actually holding. Stay informed, stay ahead. See you in the next one.